Hello, oracles. Is the stock market in an optimism bubble? Or maybe it's in a denial bubble. If anyone has seen the movie The Big Short, which is the movie that kind of plays through exactly what happened during the great financial crisis, you understand that that was going on at that time. If you have not seen it, I highly recommend it because the movie depicts what was transpiring during the great financial crisis and what led up to it. There was a lot of shady things that were going on in the financial world. And while there were some signs out there that we were heading in that direction, many people were just brushing it aside and said, well, we've been doing this for this long and haven't had a problem. So, hey, we're going to continue on doing it. And people just kept saying, well, it hasn't broken yet. And things like that will continue to go forward until they break. And a lot of times, the longer things like that go on, when it does break, it becomes even worse. So, at that time, people had started seeing the signs 2 years prior to when we actually saw the entire market break for the great financial crisis. People saw the signs leading up into it and they just kept on doing what they were doing. And in some cases, they actually magnified it because they said, hey, we're doing well, let's do it some more. And that kept on going and spiraling. And then finally, the housing market broke because there were so many subprime loans. And those are loans that, are given out to people who probably don't have the best credit or any credit or, anything whatsoever. And they probably shouldn't have had those loans. And then things broke. And when that ended up happening, obviously we saw what happened with the great financial crisis. So my thoughts are, and it's not to be bearish and to say, hey, what's going on right now, because it's not the same situation. But every time we get into a situation like that, it always has some sort of signs that are showing that are out there, and people are just in denial of it. So again, I'm not saying that's what's going to play out right now. I'm just asking the question, is that where we're at right now? Are we, maybe 3 months, 6 months, a year, 2 years ahead, seeing some signs as to some cracks going on in the economy right now that might lead us to something breaking? So we look at some things right now where everybody's optimistic. We don't even have the market pricing in heavily a potential recession. We have the market more heavily pricing in a soft landing when it comes to the Fed and getting us down to a point where we get ourselves back to where we need to be at a 2% interest rate and not getting a recession. Now, I'm optimistic as well. Again, I mentioned it on yesterday's video. I'm going to hope for the best, but I always prepare for the worst. And again, not to come off as being bearish by any means, but this is me just asking the questions as to, am I preparing for the worst? So is the worst possible? What is the worst? And obviously the worst is at this point a potential recession. So I want to prepare for that, but maybe I'm wrong. Maybe I'm being too pessimistic. I don't know, but it's always good to have both perspectives. And this perspective that I'm kind of basing right now is, well, are we looking at that? What are the signs that we see out there right now that could potentially be showing us getting into a recession? Well, first is we have consumers at an all-time high with credit card debt. So obviously, to move the economy forward, we need people spending money. And if people are spending money by using credit cards, eventually those credit cards are going to get maxed out. Eventually, people will not be able to get more credit cards and they hit credit limits. Once you get to that point, spending is going to slow down. When spending starts to slow down, that means you're going to see companies making less and less profits. And in turn, companies are going to see smaller bottom lines. Companies don't want to see that. So in order to make up for that, they're going to have to cut costs somewhere. The number one place to cut costs is going to be from labor. You start cutting labor costs, that means unemployment goes up. Unemployment goes up, that means that less people are spending on top of all of that. Less people spending continues that spiral going downward of companies having to lay off even more people. Eventually, you do hit a floor on that, and then you start to build up from there. But where is that floor? Again, just one of those signs that we see going forward. Now, when it comes to the unemployment, again, unemployment being at 4.2% is still very low. That is a very good number to be at, but the concern is the rate of inflation going up. Again, back at the beginning of August, we saw the SOM rule getting triggered, and the SOM rule shows us the speed of unemployment going up. It's not the actual unemployment level, but it has been a 100% correct indicator as far as an anticipation of recession. Every single time the SOM rule has been triggered, we have gone into a recession shortly thereafter. That got triggered in early August because unemployment is going up as quickly as it is. Now, yes, we went from a 4.3% down to a 4.2%, but the SOM rule has actually gone up as well because it tracks over the last 3 months. And what it does is it's going to take an average of the last 3 months and compare it to the same time frame from last year and looking at that going forward. So again, we went from a 0.52 to a 0.57. And so yes, while unemployment did come down that month over month, the speed of it based upon the sum rule is still going up. So we really need to be cautious and pay attention to that. And obviously, this is why the Fed has come out and spoken a lot more heavily about unemployment being their focus right now rather than inflation. The next thing that we could take a look at when it comes to signs and indicators that we are possibly heading in that direction is going to be inflation. You look at inflation and yeah, hey, we're coming down. We have a forecast coming out of a 2.6% that we are expecting to get on Wednesday. Now, that's great because last month we got a 2.9, and yes, we've been cheering inflation coming down. But now the fears are going to be, well, what if it's coming down too fast? What if we get to deflationary times? Now, you go back to the point where we're talking about consumers not being able to afford anything anymore and consumer credit being as high as it is. If prices of things come down, sure, the consumer may be able to afford things more. That's great. But it's still going to be the same problem when it comes to corporations and businesses looking at their bottom line. Bottom line's shrinking, a shrinking GDP for the government, and is going to be, again, that same reason why cutting costs and potentially cutting labor are going to happen when it comes to the market. And again, once you start cutting that labor, that's when things really start to go downhill quickly. So paying attention to that coming down, and this is where, yeah, the market's still pricing in the soft landing, but there's so many pieces that are moving right now when it comes to the Fed actually being able to pull this off is, can they do it? And now going into an election cycle right now with the market being where it's going to be at and higher volatility over the next couple of months, could be very interesting over the next couple of months to pay attention to what's going on in the economy and the Fed being able to get us to where they want to with the soft landing. Another indicator that we've seen for a recession is the 10-2 yield curve inversion. It was inverted for the second longest period in time since 1929 before the Great Depression. Now, the inversion itself is usually the leading indicator as a potential recession, as almost every single time we have seen an inversion, we have seen a recession come after it reverts back. So the uninversion or the reversion of that 10-2 yield curve is typically the signal where we start to go into that recession or we are already in one. So back in 2007, we were already in the recession at that time when it reverted, but many other times before that is kind of like the, all right, it's reverted, and then shortly thereafter that, we get into a recession. Well, now, again, after the longest period that we have had of being inverted, we have now reverted, and we're kind of balancing around there, and now we're looking at the speed of the reversion going back up. That is going to be another signal of a potential recession coming. And then lastly is earnings. And we've been seeing some spending getting cut in some areas from some companies in their earnings. Some forecasts that we had seen previously, especially when it came to retailers, forecasting out that sales for the next 6 to 12 months could be lower than expected, kind of just forecasting that out and giving us a gloomier outlook as far as the next 6 to 12 months. And so, yes, while we saw consumer spending numbers going up in August, that was the first time we had seen that in a long time. So, if that trend can continue, that's great. But we are still paying attention to what's going on because a lot of these companies were anticipating lower than expected numbers. And again, yes, maybe they set those expectations lower and maybe they're going to beat those lower expectations. But we have to remember they lowered those expectations to begin with because they were anticipating worse times going forward. And then you start looking at things like oil being under $70 a barrel. That there is, we've seen gas prices coming down. I've seen it in the past, especially going into an election cycle like this, where somehow magically the timing gas prices coming down, like almost like it's the party that's in charge is like, hey, look at what we're doing. Gas prices are coming down. Aren't you happy? Maybe it's just a coincidence. Maybe it's just timing. I don't know. It's just an observation that I've had over the years, but we're starting to see that come down. Now, in the past, we've seen different things that have caused a recession, and one of which is an oil spike. Now, looking at where we're at right now with prices being as low as they are, what happens with consumers and the majority of people and consumers that are out there aren't really good with their finances. So they say, hey, I'm not spending as much money on gas. I'm going to spend it on other things. It doesn't matter. It's not anything. They're not saving. They're not investing. So because gas prices are coming down, that means they have more money in their pocket to burn. And then they go out and they burn it on whatever. And in many cases, it's not something that they actually need. Then all of a sudden, they've built up these new spending habits that they shouldn't be spending on. And boom, gas prices start going back up. Now all of a sudden they need to start cutting spending again. And you've got businesses out there that were showing better numbers because consumers were just spending all that money on other things that they didn't need. Now all of a sudden they need to spend money on the things that they need again, gas being one of them. Oil prices continue to go up. They need to start cutting spending in all these other places because they're spending money on gas. And now, if you look at timing of it, if we're at this point and it's going to go back up after the election season, look, we've got winter coming. Winter, oil prices, the demand for oil is going to go up. Here in the US, we are now at the lowest oil reserves we've had in over 40 years. So again, it would be great if we had those oil reserves, because if we had those oil reserves, we have the prices going up. Hey, we can release some of those reserves, kind of counteract some of those oil prices going up. We don't have that as a caveat this time. We don't have that as a way out. So if oil prices start to go up, you're going to see a lot of penny pinching going on, a lot of consumer spending getting cut. And again, if consumers are already at the point where their credit cards are maxed out and they don't have any way of actually spending that money, we're hitting a wall and spending is going to stop. And again, we go back to all of those scenarios that I played out before about corporations and businesses having smaller bottom lines and starting to have to cut payroll. So I don't know the timing of how this plays out. I don't know if it's actually going to play out, but just looking at all of these signs of potential things that could be playing out, are we in denial about this? Are people in denial that this is actually going on and some dominoes are starting to fall? Are we too optimistic about the Fed actually being able to get us to a soft landing and being able to avoid all of this? I don't know. Again, I'm optimistic. I'm hopeful that we do get the soft landing and we avoid all of this. But you guys can let me know your thoughts in the comments below. Do you think there's a lot of signs that are out there that many investors and many institutions are just blatantly ignoring because they think that they're going to be able to prop this up and keep it going forward? Or do you think we have a stronger underlying issue going on where we're going to see some dominoes fall and those cracks start to get bigger and we actually see the economy break? And one thing that I see when it comes to actual stock market trading with all of this is options. We have seen, look at gambling and how big gambling has become in the last just 5 years alone, with all the different apps that are out there, how much it's promoted all over the place, TVs everywhere, so much all about gambling. And you look at the stock market and how easy it is for people to play options now. It's $0 trading. Options are all over the place. People can get margin a lot easier now. The options market is huge. The amount of options ETFs that are out there has grown exponentially. You used to have just a few of them. Now you have so many. You have ones that are zero DTE. You have ones that are going to be playing puts and ones that are playing calls and things that pay out weekly, things that pay out monthly. So many options that are being played out there by so many retail investors as well that have this extra money on the sidelines that are getting in there trying to make this money. What happens when everything reverses? What happens when we're not going up? What happens when these retail investors don't have those dollars to be able to put out there because they've got to put food on the table? What happens when all of that happens and then boom, you all of a sudden you don't have all of these inflows coming into these options ETFs and they start collapsing? I have seen that just alone with the yield max ETFs. It's almost like, what's the next hot thing? That's where all the money is going. And as soon as that's not hot anymore, that NAV erosion falls very, very quickly. And you can see things getting erased real fast out of a lot of these ETFs. So pay attention to what is going on with all of these options, because if they're not in favor, it's like a popularity contest. If they're not in favor, boom, they collapse. And the recovery on them doesn't really happen if it happens at all. And if it does, it never ever recovers as much as the underlying security that they're playing options on. So while, yes, I still have a couple of them in my portfolio, I still use them as some income. If you play them correctly and you can play them on an upswing and make some money, I did that with Coney, great. But you have to do your own research on that. And it is extremely difficult. And a lot of times it's going to be a lot more luck than anything. So be very careful with that. Plus, because they have the NAV erosion, a lot of people that are out there play puts on them. I know they did that with TSLY as that was falling down. So that's putting even more downward pressure on those. And again, they collapse entirely. Now, where do these people put their money? So just be very cautious with those and pay attention to all these underlying signals that are going on in the economy itself. Sure, we may see some volatility in the stock market itself because of the election cycle that's going on. So don't use the stock market volatility and movements as a signal as to what's going on in the economy. Pay attention to the actual numbers. that are happening in the economy. Especially as a long term investor, you still want to pay attention to this. Maybe you're a retiree that's looking to be utilizing their 401k, or maybe you're already retired trying to utilize your 401k. Could be a difficult time. So make sure you want to be prepared for that. Or if you are somebody who is trying to build up your 401k or invest for the future, maybe this is a great buying opportunity that could be potentially facing you coming up in the next couple of years. When you look historically at different times in the market that were great buying opportunities, the percentage of those is much, much smaller than the times you've seen booming times in the economy. So, times to buy low are much less frequent than the times we see when the market is going up and you're buying at a higher valuation. So, just pay attention to what's going on in all of the different pieces, but just look at those little dominoes that happen to be falling, the signals and the trends that were going on right now, and just see, hey, are these trends going to be continuing, or do we see those signals of the trends slowing down and we're actually going to get that soft landing? So that's my take on all that. Again, you guys can let me know your thoughts in the comments below about that. Do you think we have an overly optimistic market right now? Do you think that the market is in denial, or do you think that they're justified and we are going to get that soft landing? Thank you guys so much for watching. I appreciate all of your support. Have a great one.